Hey traders, welcome back. Today in this video I want to focus on the risk to reward ratio and proper good and bad risk management. Now before we proceed further, let me tell you about today's sponsor, that is CopyRack. CopyRack is an excellent copy trading and social trading platform that allows you to follow the market leaders and copy their trades. So whenever they make profit, you also make a profit. Also, you can look at their trading profiles and trading history to judge their performance in the past. If you are interested, I have put the link in the description of this video, so please make sure to check it out. First of all, let's kick things off by learning what is risk to reward ratio. So let me just move this to the side. And now let's say you have an account, a Forex trading account of $1,000. Now in this $1,000, you should not just go ahead and randomly place trades, and you should not bid random amounts of money in your trades. For each trade, you want to know how much you want to risk. For example, let's say if you are following our risk management strategy according to which you only risk 2% of your trading account, then in each trade of this $1,000 you would risk $20, and in this $20 you can either lose this $20 or you can make a profit on top of these $20. These $20 would be the maximum you want to lose if you're risking 2% per trade. For example, let's say your trade goes to loss, so you would lose $20 and your remaining balance would be $980 excluding the trading piece. But if we talk about the profit, let's say you make a risk to reward ratio of 1:6. So in this case, since you have made a 6 times the profit, so your profit would be $120. So this is basically very simple explanation of how risk to reward ratio works and what is risk to reward ratio. Now let me just go towards here and let me show you on the chart how it works. So for example, here you can see that there is an example trade where the risk to reward ratio is 1:10. So for example, if you had risked $20 or 2% of your $1,000 trading account, you would make $200 in each trade, okay, with this 1:10 risk to reward ratio. Now if we talk about this one, this trade is also in profit, but only issue here is that we are risking a lot of money for a very less profit. So for example, if we had risked 2% or $20 of our trading account, with this 1 to 0.7 risk to reward ratio, we would have only made $14. That's not even equal to what we are risking. So we want to avoid the trades that have low risk to reward ratio. Now let's move towards the charts and let's look at how you can optimize your risk to reward ratio. As I have explained, you want to target the trades that have very minimal stop loss but very high risk to reward ratio. In this case here, as we saw in this example, because here if we risk $20, we would make $200 in profit because of the high risk to reward ratio. Now how you achieve high risk to reward ratio trades is by using these two strategies. That is, you want to use very tight stop losses wherever possible, because with the smaller stop loss you can gain maximum profit with and take higher risk to reward ratio trades. And also you want to trade risk free. I'm going to explain it in the example that is coming further. So now let's go to a chart, and supply and demand zones are tools that allow you to take those high risk to reward ratio trades. For example, here we can see the formation of this rally, base and drop supply zone, in which the supply zone is drawn around this base candles. So now if we look at it, we can see that as soon as the supply demand forms, we would have put our pending sell orders, because institutions would be executing their sell orders here. So we'll put our stop loss here, and now as we can see here, the market comes back to this supply zone and picks those pending orders. Now our orders will also get executed. Now if we look closely, we can see that stop loss is above the high of this supply zone. Now what most traders do is they trade on a fixed take profit level. For example, here we can see most traders would take break even the trade at 1:1, and then they would exit the trade or close their position at 2 risk reward ratio of 2 or 2.5 or something like that. But that is not risk free trading, because risk free trades mean that you want to take maximum out of the market whenever possible, and you have to work on a strategy that works well, that lets you know that when the shift in trend is going to come, because if our sell orders have been executed, we want to ride this bearish move in the market till this level here. Okay, so let me just delete this, and once we ride this, we can see that with risk-free trade we can make a risk to our ratio of almost 5.72, which is again very good. So that's what we call risk-free trading, and you want to devise these risk-free trading strategies that you can use in order to take higher risk to our ratio trades. Also, in order to support the supply and demand zones, you can spot this manually on the chart as I have done here, or you can also use our supply and demand indicator that automatically detects and notifies you about the supply and demand zones that forms in real time. So you can use the supply and demand zones to take these higher risk to our ratio trades. And with this indicator, we also show you how you can take these risk-free trades that allow you to get maximum out of the market using a special trading strategy that comes with the supply and demand indicator. I have put the link to the indicator in the description of this video, so please make sure to check it out as well. Now, as if I recap everything, you want to focus on taking higher risk to our ratio trades, and you want to avoid these very high stop losses and very low reward ratio trades. And you can do this by using the tight stop losses and risk-free trades. I hope you were able to understand this video. If you have any questions, please comment down below. I would love to answer them. Also, don't forget to like, share, and subscribe. See you in the next video.